And apparently, and according to our next guest, Laura Wang from Morgan Stanley, Chief China Equity Strategist, there is more upside now for mainland equities and Hong Kong equities as well. Laura, why are you so confident? How much of this is tied to the kind of rebounding growth story here on the mainland?
Yeah, absolutely. This is very much tied to the rebound, the recovery story that's going on in mainland. We remain overweight on China within the global emerging market framework for several reasons. Number one, we firmly believe in the first in, first out stance of the post-COVID-19 recovery of China. The trajectory has been showing very strong sort of journey. As we all know, the production capacity has been fully normalized to 100%. And we do expect most of the consumption and services sectors to be normalized by the end of the third quarter and fourth quarter of this year. So that's one reason. And the other reason is we know that the China equity space is particularly skilled towards the online economy area. For example, MSCI China, which is the mostly followed global China index, 44% of the index weight is dedicated to online economy, like online video gaming, online entertainment, and e-commerce, so on and so forth. Whereas if you look at the broader emerging market, that online economy index weight is only about 20%. So the online economy has been proven already in terms of revenue generation and earnings delivery, particularly under the COVID-19 shock. And that would actually guarantee a much better earnings result for China equity space versus the emerging market. And needless to say, China is still trading at a discount versus the emerging market. Again, using MSCI China as a proxy, it's trading at about 2% discount versus the MSCI EM index on a 12-month forward PE basis. And very quickly about the onshore versus offshore, we do have a strong preference for the AShares market because, number one, it's trading at an even further discount versus the offshore space. CSI 300, which is the onshore AShares market index that we cover, is trading at a 12% discount versus MSCI China on a 12-month forward PE basis. This is the historical sort of 12 in terms of relative discount that we have ever seen. So it offers a pretty good entry point for AShares. And number two, we're seeing more regulatory opening up for the AShares market. Just about 2 weeks ago, CSRC actually commented about further opening up the securities index future products to foreign investors, which we all know has been a major concern by foreign institutional investors accessing AShares. So if that happens, that would be a huge positive for the AShares market as well.
Laura, that is a comprehensive response. Look, one risk that you point to and many point to, of course, is the US-China relationship. What would you need to see in that relationship in terms of a deterioration that would make you change your weighting, and how would you position in that eventuality?
Right. So it is a very serious and meaningful risk factor, and it's a very important factor to my framework. It's not a new factor because we've been watching this, we've been monitoring this for the last 2.5 years, right? For the time being, actually, I have recently reduced my overweight active risk exposure to China within emerging markets because of the resurgence of the U.S.-China trade tension. You know, back at the beginning of May, we already noticed there was comment from SEC Chairman Mr. Jay Clayton about potentially, tightening the listing requirement and also warning against investing in certain companies with sort of unclear accounting track records. And there was also the potential blocking of an investment by the thrift savings plan into Chinese companies. So we already reduced our active risk exposure because of this sort of resurgence of the tension risk. That being said, we continue to overweight China for other reasons, as what I just described to you. And also within the emerging market, we do look at China as a country, as a market with much stable sort of FX management, with much stronger external balance sheet and the sovereign payment capability. But going back to your question about U.S.-China tension more directly, I think one way from the equity investment perspective to sort of protect yourself better from such uncertainty is to be more focused on AShares. So one thing I have not mentioned about AShares is it's much less owned by foreign investors, by U.S. investors. It's only, I think,
Laura?
Across all the market caps. Yes. Yep.
Yeah, Laura, I just want to save some time because you have some good research here, and I'm sure our viewers would like to talk a little bit more about your index targets. Now, I'm just trying to read your CSI 300 index target, because you guys used a font size 2.5 here on this as well. Among the major Chinese benchmarks, the CSI 300 is the only one you guys see with very little upside, I should note, for next year. 4150. Is there upside risk to that target these next 12 months?
That's right. That's right. That's ranking order actually signals our strong preference for the Asia market versus the offshore. We do have no upside for the other sort of China equity indices, but then again, we have a lot bigger sort of downside for the broader emerging market index, which means, again, within the emerging market context, we believe China will continue to outperform. And
Laura Wang, great stuff. Thank you so
yeah.
much. Okay, I'll let you finish. What's the upside?
Yeah, so the earnings, the target price, as you just mentioned, I mean, there's the earnings forecast, there's the valuation forecast. We do have quite positive earnings growth forecast for 2021. We're forecasting 14% earnings growth because of the strong recovery. I think the valuation side is where we see potential sort of a cap in that sense, as we believe that the Chinese government is unlikely to inject sort of significant liquidity into the system. That's not what they are intending to do this time around with the stimulus package. And also globally, we're seeing that the developed market are actually, sort of injecting stronger liquidity and are going out with stronger stimulus package than the emerging market overall. So this time around, the liquidity story would be play sort of better for the developed market than for the emerging markets collectively.